if you're gonna put this up there, the reason why I asked that, I'm assuming if you put that up there, that you think it's gonna be significant towards revenue. But this could definitely be a new revenue generator that could actually have an impact on revenue. So, if you're gonna do that, you're looking for revenue drivers, and basically do that. The other thing too is if you decide to do that, and you can do that, you wanna do your best to try and quantify what you're looking at. This might, over the next 5 years, add another $5 million, $5 billion to revenue. All right. Next slide. All right, cool. Next slide. All right, we got a lot of things going on here. First and foremost, typo. Dividend is what?
Dividend is $1.2 and growth.
Which means it's $1.20.
What?
$1.20.
$1.20, yeah.
Yeah, okay, so there's a typo, it's $1.20. All right, the dividend is $1.20, and the dividend growth rate starts at 10% and works its way down. You guys gotta remember, you're dealing with a lot of growth rates. You're dealing with dividend growth rates, you're dealing with revenue growth rate. You gotta make sure you state what it is. So we're gonna assume it's in the model dividend. I'm not sure why you have Intel as the largest manufacturer with increasing net income annually, when we already kind of went through that, when now we're talking about the model, so.
You're right.
You put WAC in here. I don't have a problem with you putting WAC here. But two things, one is you need to break down WAC. So again, we need to know the assumption that go into WAC. Please don't jump around. Stay where I'm at. I'm gonna get to all that stuff in a minute. You have time to retort all that, but I'll get it out.
Go back.
All right, so your WAC calculation, your assumptions, you should actually, I'm not sure if you want it here, but you definitely need to break down your WAC and the assumptions on it.
For the breakdown, we put it's 26% debt, 74% equity, at 1.78 cost of debt and 8.45 cost of equity, and then we put 0% preferred stock, so it's not going into WAC. Our tax rate was 21%, the risk-free was 194.
All right, so do a better job of breaking that out so we understand it. All right? And your weights are wrong.
My weights?
Yeah, you're wrong.
No, they're not.
Who did it? They're wrong.
It's under.
They're wrong. You want to discuss this with me? See me? I'm telling you they're wrong. They're wrong. Who calculated them?
I did.
All right, what'd you use for equity?
Their income statement.
Class? You're wrong. Equity is 90%, debt is 10%. Your WAC is 7.76%. I just sat here and calculated it.
So 90% equity?
Equity is 90%, debt is 10%. Market cap is 251 billion, almost $252 billion. Debt is 29 billion. Again, your weights are wrong. Eliminate.
And just a quick question for you.
Sure.
And so we checked the WAC at other websites also.
I don't care what other websites do.
I know.
I'm just telling you, I don't care what they do. I'm telling you that your weights are wrong. We'll look at how you calculate your WAC later on, the numbers, and that's why we want to see your assumptions, like what you use for risk-free rate, what you use for cost of debt, so forth and so on, which is all up here. But I'm telling you, based on your weights, using your numbers, using those weights, it's 7.76. You're off by a full percentage point. All right? Guys, do not go to the internet to verify whether you think your work is right or wrong. Anyone can post anything on the internet, correct? Anyone can post anything on the internet. That's not your authority. Quote unquote, you're getting paid to do this, not to go surf the web and do research on the web and then come back and say, this is what I found on the web. All right? Sir?
You were also telling the other group, like what did you use to compare their data with
That's fine. You can look, but that's not, you're the ultimate source. So my comment to you is not, this is not you per se. Why would I pay them when I can just go to FinViz and pull all this up? Why am I paying them almost $100,000 a year when I can go to FinViz and pay somebody basically $20,000 at FinViz to pull this up and just give me the data? And give me the actual numbers. Alright, there's no such thing as a 10-year treasury bill.
30-year.
No, there's no such thing as a 30-year treasury bill.
Bond.
Bond.
Alright, cool. Boom, 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 boom. And so these are your whack assumptions. I wouldn't even bother putting down 0 preferred stock. I just would leave it out. Alright, next slide. So this is your dividend discount calculations. Okay, cool, I got it. Third bullet point, current price is $58, 42% decrease. I'm not sure if the industry understands your wording. You mean the stock is currently trading at
So the current stock price is 58.35.
currently trading at a 20% discount to its current stock price? I mean intrinsic
No.
value?
Basically, it's trade, right now it's trading at a 42% premium.
Premium.
From the intrinsic value.
That's the word I'm looking for. Premium, discount. Alright, that's the first thing. Second thing is, this is for the dividend discount model, right? Cool. Alright, so the word is it's trading at a 42% premium.
Right.
Any idea why? Just curious.
I think because our retention rate is so high, the company is still growing, so maybe dividends are not the correct way to measure our real intrinsic value.
Alright, I like that. Next slide. So this is, we gotta stop here for a minute. I'm asking a question, I'm not sure. This is your scenario analysis based on, this is not scenario analysis really. Basically what you went to actually do is to calculate what the optimal capital structure was. That's really what you want to do.
So basically the reason we did this is in case the company needed to raise more money, which capital structure is the best one to choose. What we did is we calculated the unlevered beta at 0%, and then used that beta to calculate the levered beta at different capital structures.
I got you.
And different cost of debt and cost of equity. What we are at right now is 6.609%. And then if we did have to raise money, we would say to do it at this capital structure.
Alright, couple things. One is, this is not really a scenario analysis. This is actually you figuring out the optimal capital structure. We get extra credit for it, but I mean, that's what you're doing.
Cool.
The next thing is, why is that here though, in your presentation?
What do you mean?
Why'd you put it at this point in your presentation? Why'd you jump from dividend discount model to straight whack scenario calculation?
Well, 'cause
Don't jump, just stay with me. Oh, okay, go back. So, first problem we have here really is your dividend discount model, which is actually going to show up in your actual calculations. You don't use WACC to calculate dividend discount model. What do you use? What do you use, class? Cost of what?
Cost capital,
Cost of equity.
cost of equity.
And your cost of equity was 8.93, something like that, I think, if I remember correctly.
8.45?
Is it up there? Oh, yeah. So immediately, that's what, almost 200 basis points higher than what your WACC is. So your intrinsic value calculator is about to go down even further when you use the right discount. So WACC doesn't belong here because you're not using WACC in this model.
That's what you're saying.
Go to the next, go back to the slide we were on. The only thing I'm gonna say here is, one, it's not a scenario analysis, it's optimal capital structure. Two, which I already said, I'm not sure if I put it here. And then three, you guys do realize that your weights are wrong, so once you actually can change your weights, because right now your current weight should be what? The blue line should be 90-10, or 10-90, right?
Yeah.
So it's gonna change that number. It's gonna change, it's just gonna change the table. The numbers are changed, but the tables are, okay.
I just have a quick question for you.
A quick answer.
For this, I'm sorry?
I have a quick answer.
For the sake of this class, we're using market cap as the equity, right?
The way we do it in industry is market cap for publicly traded companies. That's the industry. That's not me. It's not this class. That's the industry.
Okay.
The only time you use balance sheet is when you have a privately owned company.
I got
If
you.
it's publicly traded, they're coming right off the balance sheet.
Cool.
Based on your scenario, Intel is carrying more debt than you might want to see. But when you actually look at the market cap and how much the actual value of the equity is, they're only carrying 10% debt. They're not levered at all.
Okay.
All right, very, very low leverage. Next slide. All right, you know my pet peeve, right? Step 1, step 2, step 3. You're talking to peers. You don't have to go through steps. Just tell us who the competitors are that you use. Tell us what cash flows you're using. But we don't need to know the steps and all that other interesting stuff. All right, next slide. Now, I have no problem with this. Let me just explain a couple of things. One is, I'm always in the back of the room. I wear glasses. I'm not sure about the rest of them. That's the reason why I have you print this stuff up all the time. I can't see it. I'm having a hard time seeing it. All right, so you got a lot going on here. Second thing I would say is, I saw you hop over it, but when questions came up, you referred to it, right?
Yeah.
Put it in your appendix.
Okay.
All right, what I would have done with this is, I'd have put this in my appendix and I'd have pulled out the key data that I thought was the most important and talked about that. And then if I had questions from the audience, which is what you have, I went to my appendix, and I see you have an appendix, and I would have then gone to this. All right? So I don't have a problem with the slide per se. I just wouldn't, like I said, I wouldn't put it here.
Yeah.
You follow me?
And same goes to this one, I'm assuming.
Yeah, because you didn't spend much time on this one either.
Yeah, it comes up later.
So anytime, this goes for the whole class, anytime you have something that you think might come up in a Q&A, but it's really detailed, put it in your appendix and just put the key points that you want to talk about on the slide and put everything else in the appendix. All right. Next slide. Oh, you're on the next slide. So make sure I'm on the same slide as you. Stay there. All right. First and foremost, market multiples do not calculate intrinsic value. If you use market multiples, what did you have?
Well, we did earnings per share times PE, which I thought,
Which earnings did you use?
that was the trailing 12 months.
No, that's the multiple. What earnings did you use? You use a trailing 12 months earnings?
Yeah,
This is worthless.
okay.
Seriously, you're telling me about something, you gave me trailing earnings with a trailing, is a multiple trailing too? Or forward?
No, the multiple.
So go back to your, go back,
trailing because,
go back to your big slide, the one with all the data.
yeah,
So you use this PE ratio?
yeah,
So now the question is, and I know FinViz does this, is that the trailing PE or forward
that's
PE?
the trailing,
All right, so you gave me a trailing
and
PE
the forward
with a trailing earnings.
with a, yeah, and that's.
Are you using the $4.27?
Yeah, yeah.
So you gave me trailing PE ratio with trailing earnings. You gave me a stock price for last year.
Okay,
All right,
yeah, that makes sense.
you follow me?
Yeah.
So if you're gonna do this, you should be using, like I said, I know you guys don't have the ability to find these forward ratios, a lot of them don't post, and you have to actually calculate it. Bloomberg does have it, but if you didn't go to Bloomberg, I said, okay, you can use your trailing 12 ratio. You gotta use your forward earnings per share from both of your pro forma.
Would that be like the earnings per share for the next year or no?
Yep, next year.
Okay, it's kind of, okay, yeah,
So what you're forecasting up to next year,
that's stock price.
that would give me the stock price you think a year from now,
Yeah,
all right? You follow me?
yeah, that's, okay, just make sure.
So, go back to, go forward again, go one more. So that's the reason why I'm saying to you is, this is, the numbers don't mean anything to us, they're worthless.
Okay.
And what's the stock currently trading at, 60 what?
It's 50, right? Today it's like 57 something.
Yeah, well, guess what, I'm not surprised. You use the trailing ratio, P ratio, and you use the trailing earnings. That's already built into the stock price. That's why you got that number close to where the stock's currently trading at.
Yeah,
All right.
Yeah.
So again, I'm not sure what you did with the comps and all that, but the same thing. If you're using, this goes for no class. If you're using trailing earnings, and you're gonna come up with a trailing stock price. You use earnings that you're forecasting for a year from now, you're gonna tell me what you think the stock's worth a year from now. You can get there sooner, but that's what you think it's worth. If you're using 2 years earnings, going out 2 years forward, you tell me that's what you think the stock price is gonna be 2 years from now. All right, class?
Would you recommend just taking that out entirely?
Well, this is wrong, and
And not replacing it then?
yeah, the calculation is, I wouldn't even have this in here because your job is to calculate what you think the stock price is gonna be a year from now.
Okay, yeah.
You know,
We just
forward,
got
we're
excited
forward
with the
thinking.
numbers and we just like wanted to do other.
Not a
things.
problem. Like I said, that's why I hesitate to call it garbage. It's good work, but the problem is that you're telling me, you're confirming what we already know, and that is that the stock should be trading right where it is right now, based on the numbers and information.
Okay.
All right.
Makes sense, yeah.
Next slide. So I imagine this one's based on.
Based on the
Yeah.
change.
All right, cool.
Yeah.
Then the next slide.
Yeah.
Now this one is.
This is the forecasted.
All right. So
actual
now
price.
on this one you're using
PE and earnings per share.
you're using trailing PE. We're okay with that, but you're using your forward earnings estimate.
Yes, sir.
All right, so this is the one, that we care about,
Okay.
all right? The only thing I would add to this is, and this goes for all the guys, put the current stock price on here, and then also the comment based on your current stock price, if it's trading at a discount or premium to what you think it should be trading at. You follow me?
Yeah.
So we need to have a current stock price to reference this.
Okay.
So the current stock price is what,
58.
58, so you're talking about $4 high, $5 higher than this, $5 on $58 stock, so you're talking about under a 10%, you're looking for less than a 10% move in the stock price based on earnings.
Yeah, it's 9%.
Alright. So again, good work here, but you understand what I'm talking about. Next slide.
This goes back, we already saw.
Again, I put that,
That makes-
yep, next. Alright, hold on a second. I'm printing this. Alright, so let me see, earnings per share shows that the most, value. I'm not sure what are we supposed to take from this slide?
It was just a rundown of everything I looked at, tie it all together.
Okay.
Put it all on it and stuff.
Alright. Next slide. Alright, stay there for a minute. We got a lot, fill it in. A lot going on here. Alright, as I read this, the first thing that popped in my mind was, this belongs in your conclusion. You've got a lot of statements in here. You're halfway through your presentation. The first bullet says, discounted cash flow model using free cash flow is the best to determine the intrinsic value per share. Right? That's part of your conclusion. You're already telling us right now that, forget everything else we told you, just go straight to this. And if that's the case, if I was in the audience, the first thing I'd say is what? Why'd you waste my time with the other two? Just go straight to this one. All right. And then, like I said, the bullet points, this all reads like this now did not look reasonable at 33.66. Current intrinsic values and market multiples. Again, market multiple method is not calculating intrinsic value. So take that out. And I'm not sure what you mean by growth rates and market multiples. What are you referring to in growth rates and market multiples?
It was basically, so when we use the estimated earnings per share, the growth that we saw, can I go with it?
The previous
Sure.
one that we looked at. So when estimating the stock price for next year, the growth rates that we saw were like, which are these? Yeah. Were just like crazy and we felt like that was not.
They
Maybe
fluctuated a lot too, so this one we saw 445% growth rate.
Go back.
So we first.
You realize that those are forecasted growth rates and earnings per share.
No, they're the stock price.
You're talking about the far right-hand column, right?
Expected growth. So this is actually the change in the stock price, or change in the stock price divided by the original stock price. That's the actual equation for getting these percentages.
Oh, okay. Now,
Did this throw you off?
I'm gonna kind of agree with one of your classmates. I don't think you should be using industry.
Okay.
The semiconductor industry is so diverse and so spread. And NVIDIA, Microsoft's not even a competitor. Microsoft doesn't make chips, they use chips. What happens a lot of times with some of these sites that you go to, is they'll look at the fact it's a tech stock and they're looking at the size of the company. When you look at it, Intel, NVIDIA, AMD, 3 straight competitors.
Okay.
Those are the 3 that Microsoft, Qualcomm buys chips. They make and buy chips. And they use them to make phones and other items. IBM, same thing. The only true, pure chip manufacturers up there is Intel, NVIDIA, and AMD. I haven't looked at microchip technology in so long, I don't know what they're doing anymore. But those are the 3 I would focus on. All right, go back to the discounted cash flow conclusion slide. All right, yeah, this just reads like a conclusion. Next slide. Again, I got a lot going on here. So your bullet point, historical data to forecast values. Again, you're telling us what, I'd rather see the actual data that you're forecasting. So your growth rate begins at 10%, like I would like to see, what are you forecasting growth rate for over the whole entire model's life? Your retention ratio is 74%, which means your payout ratio is 26%. Now this was an interesting one, additional funds needed equation. I'm not sure if I had to put additional funds equation needed, so forth. Couple things, and some students are getting kind of confused with this. Pro formas and discounted cash flow are 2 distinctly different items. They're not one item. You understand that? So if you want to discuss your pro forma, then you should actually have a slide and discuss your pro forma. If you're going to discuss the discounted cash flow model, then there's no reason to discuss the pro forma. All right? With that, I would say to you, you have excess cash. What would you do with it?
Help the company grow, reinvest it by I know she talked about like some projects. I wasn't sure exactly what projects she was saying, but try to help things to grow in general. So
That's one of my why questions. You tell me that you have all this excess cash, the next thing I say to you is, what are you gonna do with it? So, that's a thought process, that's impressive.
I think it goes back into like the retention ratio that we calculated for the company, so about 27% going out in dividends, and then the rest of it is getting invested into,
I got you, I understand. I'm just saying that, since you brought it up, the thing that my mind would say to you is, what are you doing with it?
right.
And I see that you talk about, but again, what are you doing with it? And the last bullet point is, again, if you would give this presentation to a 303 class, that'd be great. For us, we don't need to say it. Next slide. Yeah, I think you got my points on this. I would just, you put it up here. There's no reason to put the negative sign because you're saying it's additional funds needed. And then my question is, what would you do with it? Next slide. All right, you jumped into free cash flow and you just gave me your final numbers. What do we want to see?
the work.
I don't need to see the work. We all can do the work. What do we need to see? The assumptions. I'm more concerned with the assumptions. All right. Now, go ahead, I'm sorry.
Assumptions, could you just like give us like a couple examples?
The assumptions, what you use for, in the model. So what you use for the growth rate, what you use for terminal rate, I'd rather see more of that. Now, here's the question. You had debt on there, when your debt to weight calculation is 26 billion. On here, you got 37 billion. How could they be so different? Just saying. All right, you follow me? They're different numbers, so I'm not sure what's going on. And again, when you get done, I'm not saying your model's wrong, but when you change your WACC, you're probably going to be trading, your treasury value is probably going to be at a discount to where it's currently trading, just based on numbers. I'm not saying it's right or wrong, I'm just saying. All right. Yeah, I wrote down here a whole bunch of, where's your assumptions? Next one. this one on top I wrote, huh? So let me back up and say this. First and foremost, interesting work, good work, interesting. But I'm not sure how we can use that. You follow me? Because the bottom line is, I'm not sure how we, if the corporation could even do anything to get their tax bracket moved lower. That's the, it's internal, that's internal that they gotta do. So, I just don't know what, interesting, but I don't know what use of, what value it brings, just other than like a FYI. Next slide. Next slide. Next slide. Yeah, so right there, this is why I noticed that your WACC, that should be cost of equity. In your calculation, see it? Your assumptions? You should be using cost of equity, not WACC. So that's why I said this number's gonna go lower.
You got it.
Everything else looks fine, but that's the first thing. Go back real quick. Just curious, you use 2% terminal growth rate here. What you use in your dividend your discounted cash flow model?
We use the same.
Okay, be consistent. Okay, cool. Next slide. I'm not sure what the numbers are for, but that's okay. The next slide. So this is you unlevering the beta, levering it back. Next slide. Next slide. All right, I don't see anything on here. Well, like I said, the only thing I do see is that, like I said, your WACC is gonna be a little higher. So it's gonna impact that. All right, good job.